Not doing this step will not only wreck your trading mindset, but also your bank account. So in this video, I'm going to reveal what the simple step is, how any level of trader can easily transform their trading career, and show you the proof of its effectiveness. But first, let me show you what happened to traders who ignored this step. From our earliest days of punching in at our traditional 9-to-5 jobs, we've been conditioned to believe that even the slightest slip-up could spell disaster for our career. It's a mindset ingrained in us from the very beginning. So when I embarked on my trading journey over a decade ago, that ingrained fear of making a misstep followed me like a shadow. So I set my sights on those tiny, small profit margins because they seemed secure to me, right? Much like I would avoid any mistake that was drilled into us as a taboo at our workplace. It felt like I was trying to walk on a tightrope, cautious to the extreme, for I knew that even the smallest slip-up could send me tumbling into the abyss of losses. The echoes of conventional wisdom had me convinced that one wrong move would shatter my aspirations. Yet despite my best intentions, my account balance stubbornly stayed in the red, and that's when it struck me. I had it all backward. Those losing trades held the key to making it work. So I needed to discover a way to leverage those losses and capitalize on those wins. The plastic cup represents your trading account, and the water inside is your trading balance. This hole is a losing trade. Instead of trying to seal the hole, you're trying to refill the cup. Doesn't that seem counterproductive? What we need to do is seal the hole, reuse the cup, or Greta Thunberg will haunt us, and refill it. I figured out two different ways to make this work. One of them was to enter a trade with 50% of my max position at the start and add the remaining 50% as the trade goes in my favor. I could also enter with my maximum position and add an extra 100% when the trade goes in my favor. I knew this method required diligent risk management, where I need to adjust my stop loss to break even as soon as I add into my position. The other approach I found was to simply increase my duration in the trade. By doing so, I would increase my profit targets. And by increasing my profit targets, I would have a higher risk to reward ratio. To put it simply, for every $100 I risked, instead of going for the usual $200, which is a 1 to 2 risk reward ratio, I would go for a $500 trade. Both of these options, like many aspects in trading and life in general, come with pros and cons. However, in reality, even these minor disadvantages outweigh the risk of ignoring this step. This is because there is significant power in mastering the skill, not only in trading, but also in business. After all, if you truly want to succeed in trading, you need to treat trading as a business, not as a get-rich-quick scheme. And here's me, staring at the prospect of opening a high-cost ice cream shop with a lofty goal of selling 900 ice creams daily. I feel the weight of the risk. It's a monumental liability, and doubts loom large. But then, a different idea dawns on me. What if I opt for a low-cost ice cream shop with healthier profit margins? In this scenario, selling just 100 could keep me profitable. Suddenly, the ice cream business seems enticing. It appears more manageable and less risky. With the shift in perspective, I chose the road less traveled and went on to open an ice cream shop. I ascended to multi-millionaire status, courtesy of those colossal profits. They erected monuments in my honor in front of every ice cream shop around the globe. Oh, wake up, you fool. Similar to the mixed feelings I experienced when contemplating the idea of opening an ice cream shop, these two traders employ two distinct approaches, one successful and the other unsuccessful. First, there's Matthew, a trader with a 90% success rate. On the surface, he appears exceptional. However, the catch is that his gains are small, and when he's wrong, he incurs significant losses. So to put it simply, a high win rate alone does not guarantee success. And we are not including trading fees, brokerage fees, commissions, and all of that. So this will make the loss even greater when you include real life. This is something most traders who promote high win rate strategies never include in their backtesting systems. Now, let's meet Luke, whose success rate is a mere 25%. At first glance, you might consider him a terrible trader. But here's the surprise. When Luke is wrong, his losses are minimal compared to the gains he makes from his winning trades. In simple terms, when he's right, he reaps substantial profits. His risk to reward ratio is impressive. And if you don't want to take my word for it, take the word of someone more credible than myself. George Soros stated, "The most important factor in trading isn't whether you're right or wrong, but how much money you make when you're right." These true traders have showed us that in the grand scheme of things, the success rate is irrelevant. And what truly matters is just as George Soros said. Successful traders I've met follow this approach. Those who do not typically find themselves unsuccessful because it doesn't work in the long run. The thing is that everything I've just told you is completely useless because there's one thing that prevents all of this from working. So if you want to solve this problem and get on your way to start making profit, then watch this video over here.